Coming up in today's show, the Dow's on its longest winning streak since 1987. The Fed hikes rates to a 22-year high and leaves the door open for more. The cardboard box recession. Google rips higher after earnings, as does Meta, and Chipotle drops after theirs. Welcome back to the Click Capital Daily Show, everybody. My name's Jared, and I'm going to run you through all the most important news, data, and charts from the markets today. And so it was a pretty mixed day out there. We got the Fed hike as expected, and we're getting into the thick of earnings. That's why we saw a good pop in Google today. We got Meta ripping up after hours, and we saw a pretty good pop in Boeing and Union Pacific, which I'll get into a bit later on the charts. And then we've got a bit of weakness in the software and semiconductor sectors, which I'll also look at the price action of those stocks on the charts later. So stick with me today, and I'll get you all up to date here with what's going on in the markets. And so no surprise here from the Fed, was exactly as we predicted. They did the hike. We've now got rates back to levels not seen since 2001, and Jay Powell's firm about getting inflation down. He said he's remained committed to bringing inflation back to the 2% goal, and no one should doubt that. And he hasn't come out and declared victory on inflation just yet. He even said it's possible they could raise rates in September meeting if the data warranted it, but also said they could hold steady as well. So kind of just walking the line, remaining neutral. And so the next big thing before the next Fed meeting in late September, 6 weeks away, is we're going to get 4 reports. 2 employment and 2 consumer inflation. Those will be the big ones the market's looking at. Because we get an uptick in inflation, Fed Fund futures are going to increase the probability they will do the hike in September, and it'll start stacking odds they may do another one in November, and then that might get the market nervous, because then the question becomes, well, when does the Fed stop? What is the terminal rate? And when you look back at the average rates over the last 50 years, it has been more closer to 6-7%, and that's with inflation averaging around 2-3% as well. We've still got the highest inflation in decades, and interest rates aren't back at their long-term average. So it's not unreasonable to think that we could get to a 6% terminal rate before the Fed signals they're pausing, and even after then we could stay on pause for a year or longer until that inflation does get back down to 2%. And one of the biggest inputs in inflation is the price of commodities. And you can see here on the chart we're breaking out. It did a good job holding and regaining this big support zone. And I'll take you out to a weekly chart. You can see we've done a clean break of this downward trend line here, and we're starting to tick back up. And there's a look at crude ticking up as well. But on the weekly chart, we can still see it has a bit of a ways to go to make those higher highs. However, agricultural commodities, big input into the price of our food, is making high highs and high lows on the daily chart in a solid uptrend. And just looking at the weekly chart, it's coming back to those highs from early last year. So if we do get a little surprise uptick in CPI, that could spook the markets a little bit. And even if the Fed was done and that was the last hike today, which some say it is and the stock market's definitely hoping it is, they'll still keep those high rates on pause for longer. And even modeling those rates now could cause problems for companies if they do stay on hold for longer. And that's because the interest coverage on companies will go way down. And that's basically the ratio of earnings versus the interest expense on their debt. And so if we've still got elevated rates in 24, 25, when a lot of corporate debt is due to be refinanced and they have to refinance, even assuming investment grade yield of around 5.5%, that'll still bring the interest coverage ratio down to multi-decade lows. And that's assuming no change in debt or earnings. So if rates were to go even higher and earnings were to continue contracting, then that average interest coverage ratio could get down to really dangerously low levels. And that's kind of the thing about debt, isn't it? You kind of kick the can down the road until one day you do have to pay the piper. However, for now, the good times are still a-rolling, and we've got the Dow Jones Industrials on a 13-day win streak. That's the longest since 1987. And we don't have much historical samples to go off with this pattern. However, the previous 4 times that occurred, a winning streak of 12 days or more, generally speaking, 3 months and a year later, we were higher on average, 9.3%. And that's because we've been seeing a bit of a rotation into those old economy stocks and a bit of broadening in the breadth in the market, with small caps, mid caps playing a bit of catch up, and we've now got industrials leading the way. And so the market was largely expecting a recession to hit by now, but we've got cooling inflation, hype over AI, and fading recession fears, with pretty much everybody not thinking we're going to get a recession this year. And that's helping to keep the stock market on a bit of a roll here. And that's helping suppressing volatility to super low multi-year levels. And even today, Fed Day was normally a big eventful day. It was one of the most uneventful Fed days I've ever seen, and very predictable with what the Fed would do and how the market would react. And we're now getting into the second half of the year, and we've only had 16 drops of 1% or more this year versus 37 through the same date last year. And just looking at the S&P, the latest 1% drop was May 23. So it's been a couple of months since we even had a half decent down day in the market. And most years you will get a 10% correction in the market, and we're still yet to see that as well. However, we are going into a seasonally weak period for the stock market. Between July and late October, we typically see a sideways pattern or some pullbacks and corrections before the market usually rallies going into the Christmas period. And we've got quite the strong divergence in opinions out there. We've got a lot of people like this article here saying that generative AI is going to unleash the roaring 20s productivity boom and a long S&P 500 bull market. However, to counter those bullish arguments, we've got things like the worst cardboard box recession since 2008 could be a sign of broader economic weakness. And that's because cardboard box sales have seen the biggest contraction since the Great Recession of 2008 to 2009. Packaging Corp of America just reported an almost 10% year-on-year slump in second quarter shipments. And cardboard box can be used as an economic indicator to kind of give you an idea of how much goods are being purchased and moved around the economy. And we can see that in the weekly chart on Amazon, still well off its highs from mid-2021 when it got up to 188 a share, and we're still 60 points off that at 128 a share today. We've also got asset bubble experts like John Hussman making a pretty bold prediction that the S&P 500 could crash 64% from current levels. He said extreme equity valuations and unfavorable market internals will trigger the slide, and such a slump will lead to the collapse of the most extreme yield-seeking speculative bubble in US history. Pretty bold claim there. And he said a 64% loss would be required in the S&P 500 to restore the run-of-the-mill long-term prospective returns. And he may be right, because when you look at the 10-year PE on the S&P 500, also known as the CAPE ratio or the Shiller PE ratio, we're currently at 31.83. And so basically that's the inflation-adjusted price earnings over the last 10 years. And if you look back in history, the only times we've been above 30 was back in 1929, before the stock market had a massive 80% crash over the next couple of years. And then the big tech bubble run up in the late 90s going into 2000. Again, which the Nasdaq had an 80% drop over the next couple of years. So for all those people that are saying we're in a new bull market, we'd really have to see earnings accelerate significantly to bring these valuations down, or they're claiming we're going into some new paradigm where equity market valuations say permanently elevated and more than double their 150-year average. And just like the late 90s, a lot of people are noticing the stretched equity market valuations, including this fund manager who's beaten 99% of his peers over the last 5 years and warns stocks face destruction as hype around AI stocks lifts valuations to dot-com bubble levels. And because just about all of the index returns since January can be attributed to a few stocks, Bill Smead says that likely signals trouble for the index once the mania ends. And so this guy who runs a value-style mutual fund said unfortunately the market for most stocks will be affected by the damage which will be done when this fad hits the wall and does the normal destruction that occurs when financial euphoria gets unwound. He said he saw the same things like back in the Nifty 50 era in the early 70s, the dot-com bubble in 2000. He also shared 3 charts which show why we might be nearing the end of the rally. The first being the S&P 500 call options volume, which is at record highs. And if you've been watching my daily show, you can see me comment on the options market and how persistent this call option volume has been and how lopsided the market has been and how persistently low the equity put-call ratio is. Second, he shows that the top 7 stocks in the S&P 500, also known as the Magnificent 7, that's Microsoft, Apple, NVDA, Tesla, Amazon, Meta, and Google, all now have a collective price-to-free cash ratio near 70. And that means for every dollar in free cash flow, investors are now paying $70 for that dollar, which he said are nosebleed levels. And third, he said the tech sector of the S&P 500 is hitting valuation levels last seen during the dot-com bubble. He's looking at the PEG ratio, which is the price to earnings growth. And we can see now we're just as high as we were back in 2001, and it only got a little bit higher back then. However, just because we're expensive and overvalued doesn't mean we can't keep ripping higher. But at some point, those Federal Reserve hikes will have to eat into it and just keeps making the yields on bonds much more favorable against the earning yields on stocks. We had a nice pop-up in Google today after their earnings yesterday afternoon. And after the market was initially worried with Microsoft jumping out on the lead with ChatGPT and initially marking the stock of Alphabet down, looks like they've proven those fears wrong and they've bounced back. They've delivered good numbers. And we can see that on the chart today with the market taking the price of Alphabet shares up to new year-to-date highs. And this was contrasting Microsoft, which actually finished down almost 4% today, closing underneath its 50-day VWAP. We also just got Meta earnings after hours as I speak. And we get a nice little pop here. They just reported second quarter net income of $2.98 a share versus $2.46 a year ago. Revenue climbed 11% year over year. Analysts had been expecting $2.91, so that was a little bit of a beat there. And the market doesn't seem to mind that they're sinking a lot of money into the metaverse and virtual reality, now racking up a loss in excess of $21 billion. as they try to reposition their business for a future that includes the metaverse and virtual reality. And so we had seen a bit of weakness in the stock price the last couple of days, but just taking you down to a 5-minute chart. After hours here, as soon as we got that announcement, there was a big pop-up and it looks like it's holding on to it. Currently up 7.2% at $3.20 a share. Just out in the weekly chart, so that's a new year-to-date high. And we continue that big bounce up from $88 a share we saw in October last year, after the market initially didn't like them sinking tens of billions of dollars into the metaverse. However, that opinion seems to have changed of now, and it was pretty cheap down here on a valuation basis as it got hammered quite hard, coming off near 400 down to under 100. We also got popular fast food restaurant Chipotle reporting earnings today, and even though they beat on their numbers, they did say inflation is hitting their popular menu items and expecting this current quarter to be weak. And just going down to a 5-minute chart here after hours, we can see the market sold them off pretty hard, currently down 8.6%. And this has been one of the best performing stocks in the market for quite a few years now, and hasn't been too far off all-time highs, but may have gotten a bit ahead of itself and is currently richly valued. As we can see on our stock fair value indicator, currently got fair value at $12.75, a bit below where we are now. And just a quick look at economic data out today. We saw those new home sales month over month only decreased 2.5%, a bit better than expected. Consumer confidence came in a little worse than expected in France. Then tomorrow we're getting the interest rate decision from the European Central Bank. They're expected to jack their rates 0.25% as well to 4.25. Then we'll be looking at the weekly jobless claims out of America, durable goods orders, GDP growth rate, and then finishing out the week with some inflation data out of Europe, along with some PCE and personal spending data in the States. After the Fed meeting today, the Fed Fund futures market increased their probability the Fed will hike again in September to 24%, and currently priced in a 32% chance we'll have that hike done by November. So stock market, a lot of people really hoping the Fed is done here, but according to their language and looking at the Fed Fund futures market, that is not a given just yet. So we're really looking at the next 2 CPI prints and unemployment reports. And if we see a surprise uptick in inflation, you can expect these probabilities to jump significantly that we will get another hike done this year and maybe even a second one as well. Which again, it would just be truly remarkable to see tech stocks continue on this parabolic rise in the face of all these rate hikes. No surprise in the fear and greed index, which just looks stuck in the extreme greed zone in one of the most persistently overbought markets I've ever seen. And that's largely thanks to that options market, like we've been noting. 58% of them calls today was a bit quieter in volumes, and dark pool traders continue to diverge from the market. Corporate insiders aren't too excited about buying their stock up here either. Okay, back into the charts. Another day, another new year-to-date high on the S&P 500, creeping up to 45.82 before pulling back again. And we've now got the equal weight S&P 500 just shy of its year-to-date highs from early February, coming up to a bit of a resistance zone here. Nasdaq's been a little bit weaker, still on a bit of a pullback, and there's the Dow on that 13th day winning streak, the biggest winning streak since 1987, and we are getting a bunch of reversal signals here in a resistance zone. We can see the dynamic swing index is significantly overbought at 16.3. And just taking you out to a weekly chart, we're not too far off those all-time highs from early last year. And this could be a zone where the market stalls out and consolidates a bit. We also got mid-caps just a few ticks off their year-to-date highs. And small caps as measured by the Russell 2000, not too far away from their year-to-date highs either. Now, we've still got micro caps quite a bit off those February highs. There's a look at Canada's TSX stalling out a little bit in a resistance zone. UK's FTSE as well, maybe putting in a lower high here, maybe confirming a downtrend. Germany's DAX stalling out in a big resistance zone. Japan's Nikkei still pulling back a little bit. And Australia's 200 index perking up a little bit and breaking out to multi-month highs. There's a little bit of a continuation in China's 50 index after they're announcing more measures of stimulus to help their economy. And there's the VIX falling down to its knees again here in the low 13s, and just looks like this market is asleep at the wheel and could be in for a bit of a summer-long slumber. Bond market volatility as well is continuing to decrease here, 104 on the MOVE index, but still overall really elevated compared to stocks. Just looking at breadth here, looks to be stalling out a little bit. 100 stocks making new highs on the NYSE today, and just 59 stocks making new highs on the Nasdaq, pulling back a bit from last week, where they had been pushing higher. And there's the growth first defensive sectors spread, still holding underneath its 50-day VWAP. Same with growth first value stocks, and small caps continue to hold up against large caps. And there's the Dow as well versus the Nasdaq starting to perk up a bit. Got the Fed sensitive 2-year government bond yield still a little elevated here at 485. Got the dollar index sitting just above 100 today, and Bitcoin trying to hold on to its 50-day. But gold sneaking up a little bit high here, approaching $2,000 an ounce. And a bit of a pullback in wheat today after we did get a bit technically overbought. But another new all-time high on orange juice. There's the cannabis ETF. Right down in a support zone, giving off reversal signals here. Still got semiconductors stalling out after they've lost momentum. The IPO sector continues to trade well. Home builders still holding up there. And the winner today was regional banks breaking out to another multi-month high and looks to be invalidating these reversal signals. And just a bit of a bird's eye view at all the sectors here. Still mostly green across the board. Weakest sector is biotech. The airlines have come off a bit. However, it is still mostly uptrends across the board. Over to popular stocks, and BlackRock's still pulling back a little bit. Still got JP Morgan trading well. Apple's consolidating a little bit. Amazon just lost its 50-day VWAP in quite a few months, and we got earnings coming out in 8 days. NVDA came off a little bit, as did Tesla. And we've also got AMD and Netflix below their 50-day VWAPs as well. So apart from Google and Meta, which are breaking out new year-to-date highs after the market, we've got the rest of the mega cap techs looking a bit weaker here, like Tesla and Microsoft, and a few of the smaller ones, AMD and Netflix as well. Starting to get a little damaging price action there. Pretty good day in the meme space today. Actually got Tupperware ripping up another 42%. Nikola are up 10%, but we did see Snap come off 14% after their earnings. We've got railroad operator Union Pacific popping up 10% today after earnings. They did miss on their estimates. However, they had news coming out that they're getting a new CEO coming in, and the market obviously liked that. Boeing released their earnings as well. Came in with a bit better numbers than expected, and the market bid the shares up 8.7%. And there's PacWest up 27% after that buyout offer yesterday, which also helped Western Alliance break out. Same with Zions and First Horizon, and continued good price action across the big guys as well. Okay, that's it for today, and it looks like the grind continues higher. And until we get a real breakout in that VIX, we may just keep marching higher towards those all-time highs around 4,800 on the S&P 500. But that will depend largely on how the rest of Q2 earnings seasons go. So far, so good. 77% of companies are beating their estimates. The bar has been set low, but nonetheless, they are beating. And like I said, the big thing over the next couple of weeks will be the next CPI print inflation. The stock market really needs to see inflation to keep tracking down to justify this rally. But if we get any surprise uptick in inflation, then that could lead to that correction. So we'll just have to wait and see whether these higher commodity prices are going to find their way into higher CPIs. But so far, the bond market's not quite sure that the Fed is done yet. Thanks very much for watching and hitting that like button, and I'll see you guys again tomorrow afternoon.